Good afternoon. My name is Ainsley Johnston.
My name is Mira Landau.
My name is Rohini Gupta.
My name's Neil Juan.
And we are
Enmar
Incorporated. Today we will be discussing the strategies and recommendations associated with our product Able and our experiences with the Capstone Foundation. I will now pass it over to Mira to explain our intended strategies.
Our intended strategy at the beginning of the competition was based off of what we had learned in class to ensure our product reached its highest potential. We wanted to issue the maximum long-term debt each round. This was because we needed loans to start off our product. However, we didn't want to pay back these loans until later, when our product had successfully gotten off the ground. We also wanted to sell stock because we needed money to create and produce our product, and this was a good way of obtaining that income. We set our promo budget and our sales budget very high, so that there would be high customer awareness and accessibility, which would then result in more people buying our product. We decided to dominate the low-tech market with one product and focus our attention on making that one product of the highest quality. We wanted to lower our revision age and the age the product will be when it reaches the market in order to get the product into the market as quickly as possible. We decided to never take out emergency loans or short-term debt. This was so we would not have to pay back early on in the rounds when we were still bettering our product. Finally, we decided to never pay dividends as to not have to spend any more money that could be used towards bettering our product. I'd like to pass this on to Neil now to discuss strategy evaluation.
Some successful outcomes to our strategy is that we were able to accurately adjust our price and specs to compete with the other products in our market. We forecasted accurately every round after round 3, which led us to have an ideal amount of inventory left over. Some downsides to our strategy was that we did not introduce any new products, which led to a very low market share, and we were also not able to make enough profit. We also did not issue enough stock early on, which led us to have less money. We were also really hesitant on investing on automation early, even though we were low tech and we relied on heavy automation. We also waited too long to buy more capacity as we sold out in the first 3 rounds every single time. I'm going to pass it on to Rohini for recommendations for the incoming management team.
My first point concerns the addition of another product. Since our product Able is above 90% for customer awareness and satisfaction, it is important to introduce another product to the market to increase market share and profit. We recommend that this new product be low tech and you improve as you go along. Our second recommendation has to do with long-term and short-term debt. As year 10 is close approaching, make sure you have enough retained earnings to pay back the long-term debt. If you notice that profits are running low, consider selling more stock or even selling capacity. Continue to take out long-term debt and only take out short-term debt for assets that can produce revenue quickly. Our third recommendation has to do with maintaining the promotional budget. At the value that the promotional budget is currently, customer accessibility will continue to rise. Only once the accessibility is at 100%, we recommend that you begin to decrease the budget to increase your investments in other places. And our last recommendation has to do with production capacity. In the first couple of rounds, we tried to play it safe and not produce as much. Consequently, we kept selling out, which seems good at face value, but there is so much missed opportunity. Keep increasing production capacity for Able and start with a high one for the new product. I would now like to pass it on to Ainsley for our key takeaways.
Our first key takeaway is issuing maximum stock from the beginning, as it is important to establish the company. It is better than issuing bonds because with stocks, the company does not have to pay interest. If companies wish to increase stock price or want more ownership of the company, they are able to retire stock. We were conservative with the amount of stock we first issued, which did not allow our stock price to reach its maximum each round. Our second key takeaway is to have a high market share from the beginning in order for your product to control the market. Capstone is an oligopolistic competition, therefore companies compete with product differentiation. We did not have as large of a market share as we intended because we went into the first round with a monopolistic mindset and failed to pay attention to other companies' products and the consumer's reaction to them. Our third key takeaway concerns leverage. The ideal leverage is between 1.8 and 2.8. Our company's assets were almost equal to our equity, so we only had a leverage of around 1.1. To increase our assets, we could have invested more into plant equipment or keep more inventory. To decrease our equity, we could have used our excessive retained earnings to buy back stock. Next, Due to the law of supply and demand, it is important from the beginning to strive to meet your equilibrium price each round in order to not have inventory left over at the end of the year for higher customer satisfaction. In the beginning, we sold out of all our products, which means our supply was lower than the demand, so we raised our price to try and meet the new equilibrium price. Lastly, it is important to create a new product when you are unable to efficiently produce one product in order to have a comparative advantage in the industry. Our product was not doing well, and therefore we tried to introduce a new product in the 6th round, which was too late. We should have created one in the 2nd or 3rd round when we did not have a comparative advantage.
Overall, participating in the Capstone Foundation was a good experience. It was a great opportunity for us to put our course materials into practice and have a better understanding of what it is like to run a business. For the incoming management team, we wish you all the best in your future endeavors, and we trust that you will have a successful run. Thank you very much for your time.